Important terms in mutual fund. 1. AMC. AMC stands for Asset Management Company when referring to mutual funds. An asset management company is a financial institution that manages and invests funds on behalf of investors in various securities, including stocks, bonds, and other assets. The AMC charges fees for managing the fund, which is typically a percentage of the assets under management. 2. Benchmark. Benchmarking refers to the practice of comparing the performance of a mutual fund to the performance of a designated benchmark index. A benchmark index is a representative market index that serves as a standard for evaluating the fund's investment performance. The benchmark index is typically chosen based on the investment objectives and asset allocation of the mutual fund. By comparing a mutual fund's returns to its benchmark, investors can assess how well the fund has performed relative to the overall market or a specific segment of the market. Here are a few ways benchmarking is used in mutual fund analysis. A. Performance evaluation. Investors compare a mutual fund's returns to its benchmark to evaluate its relative performance. If the fund consistently outperforms its benchmark, it suggests that the fund's investment strategy has been successful. Conversely, underperformance relative to the benchmark may indicate the need for further analysis or reconsideration. B. Risk assessment. Benchmarking helps investors assess the risk associated with a mutual fund. By comparing a fund's volatility and standard deviation to that of the benchmark, investors can gain insights into the fund's level of risk. If the fund exhibits higher risk than the benchmark, it may be taking on additional risks that should be considered. Benchmarking is an important tool for investors to gauge the performance and risk characteristics of a mutual fund. However, it's crucial to consider other factors such as expenses, investment strategy, risk tolerance, and the fund's stated objectives in conjunction with benchmarking to make informed investment decisions. 3. Beta. In the context of mutual funds, beta is a measure that indicates the sensitivity of the fund's returns to fluctuations in the overall market. It quantifies the fund's systematic risk, which is the risk that cannot be diversified away through portfolio diversification. Beta is calculated by comparing the historical returns of a mutual fund to the returns of a benchmark index. Beta equals covariance, fund returns, benchmark returns, variance, benchmark returns. Components includes a. 1. Covariance. It measures the extent to which the returns of the mutual fund move in relation to the returns of the benchmark index. A positive covariance suggests that the fund's returns tend to move in the same direction as the benchmark, while a negative covariance indicates opposite movements. 2. Variance. It quantifies the dispersion or volatility of the benchmark index returns. Variance measures how much the returns deviate from the average return of the index. The resulting beta value can be interpreted as follows. Beta greater than 1, the mutual fund is expected to be more volatile than the benchmark index. It tends to magnify the market's movements, both on the upside and downside. Beta equals 1, the mutual fund is expected to have a similar level of volatility as the benchmark index. It mirrors the market's movements. Beta less than 1, the mutual fund is expected to be less volatile than the benchmark index. It tends to have smaller fluctuations than the market. Investors often use beta as a risk indicator. A higher beta implies a higher level of systematic risk, which means the fund's returns are likely to be more sensitive to market movements. On the other hand, a lower beta suggests lower sensitivity to market fluctuations and potentially a more defensive or stable investment. It's worth noting that beta is just one factor to consider when evaluating a mutual fund. Other factors such as performance, expense ratios, investment strategy, and risk tolerance should also be taken into account to make informed investment decisions. 4. CAGR. CAGR stands for Compound Annual Growth Rate. It is a measure used to calculate the average annual growth rate of an investment over a specific period, assuming that the investment has grown at a steady rate each year. CAGR is often used to evaluate the performance of investments, including mutual funds and other financial instruments, over multiple years. It provides a standardized way to compare the growth rates of different investments, regardless of their varying annual returns. The formula for calculating CAGR is as follows. CAGR equals ending value, beginning value, caret, 1, number of years, 1. Here's a breakdown of the components. A. Ending value. This represents the final value of the investment at the end of the specified period. B. Beginning value. This refers to the initial value of the investment at the beginning of the specified period. C. Number of years. This indicates the total number of years over which the investment has grown. It represents the annualized rate at which the investment has grown or compounded over the given period. CAGR is a useful metric because it takes into account the compounding effect of returns. It reflects the smooth, steady growth that would be equivalent to the actual fluctuating growth of the investment over the period. Investors can use CAGR to compare the performance of different investments or to assess the historical growth rate of an investment. However, it's important to note that CAGR does not provide information about the volatility or fluctuations in returns over the period. 5. XIRR. XIRR stands for Extended Internal Rate of Return. It is a financial metric used to calculate the annualized rate of return for investments that involve multiple cash flows occurring at different points in time. SHRE takes into account the timing and magnitude of cash flows to provide a more accurate measure of investment performance. Unlike CAGR, which calculates the growth rate of a single investment over a specific period, XIRR is used when an investment involves irregular cash flows, such as in the case of mutual funds with periodic contributions or withdrawals. The formula is typically solved iteratively using numerical methods, such as Newton's method or Excel's XIRR function, to find the rate that makes the present value of cash inflows equal to the present value of cash outflows. SHRE takes into account both cash inflows, such as investment contributions or dividend payments, and cash outflows, such as investment withdrawals or expenses, at different points in time. By considering the timing and magnitude of these cash flows, XIRR provides a more accurate measure of the investment's annualized return. SHRE is commonly used to evaluate the performance of investment portfolios, including mutual funds, that involve regular or irregular cash flows. It allows investors to compare the performance of investments with different cash flow patterns or to assess the historical return of investments with complex cash flow scenarios. It's important to note that XIRR is a forward-looking metric that assumes the same rate of return will continue into the future. It does not account for changes in investment strategy, market conditions, or other factors that may affect the future returns. Therefore, it should be used in conjunction with other metrics and factors to make informed investment decisions. 6. Portfolio turnover. The portfolio turnover ratio is a measure that indicates the frequency with which the holdings in a portfolio are bought and sold over a given period. It quantifies the level of trading activity within the portfolio and is expressed as a percentage. To calculate the portfolio turnover ratio, you would typically use the following formula. Portfolio turnover ratio equals total purchases plus total sales, average portfolio value. Here's a breakdown of the components. A. Total purchases. This refers to the total value of securities bought or acquired during the specified period. B. Total sales. This represents the total value of securities sold or disposed of during the specified period. C. Average portfolio value. This is the average value of the portfolio over the same period. It is calculated by taking the sum of the portfolio's beginning and ending values and dividing it by 2. The resulting portfolio turnover ratio indicates the proportion of the portfolio that has been traded or turned over during the specified period. A high turnover ratio suggests that the portfolio manager is actively buying and selling securities within the portfolio. On the other hand, a low turnover ratio suggests a more passive or buy and hold approach, with fewer changes in the portfolio's holdings. It's important to note that a high portfolio turnover ratio does not necessarily imply better performance. 7. Standard deviation. Standard deviation is a statistical measure that quantifies the volatility or dispersion of returns from an investment, including mutual funds. In the context of mutual funds, standard deviation is used to measure the historical variability of the fund's returns around its average return. It helps investors gauge the fund's level of risk and volatility. A higher standard deviation indicates greater price or return fluctuations, while a lower standard deviation suggests more stable returns. 8. The Sharpe ratio. The Sharpe ratio is a measure used to evaluate the risk-adjusted return of an investment or a mutual fund. The ratio helps investors assess the potential reward of an investment relative to its volatility or risk. The formula for calculating the Sharpe ratio is as follows. Sharpe ratio equals average return of the fund, risk-free rate, standard deviation of the fund's returns. Here's a breakdown of the components. A. Average return of the fund. This refers to the average historical return of the mutual fund over a specific period. It gives an indication of how much the investment has grown on average. B. Risk-free rate. This represents the return on a risk-free investment, such as a government bond or treasury bill. Standard deviation of the fund's returns. Standard deviation measures the volatility or variability of the fund's returns. It quantifies the degree to which the returns deviate from the average return. A higher standard deviation indicates greater volatility. The Sharpe ratio allows investors to compare the risk-adjusted returns of different mutual funds. A higher Sharpe ratio implies a better risk-adjusted performance, as it suggests that the fund has generated higher returns relative to its level of risk or volatility. Conversely, a lower Sharpe ratio indicates a lower risk-adjusted return.